The first break-even problem has several parts. The first part is how much is the contribution margin? Well, you know that the contribution margin is sales price less variable cost. So, if you take a $40 sales price and you subtract out your $20 variable cost, you end up with a contribution margin of $20. Just do not forget that this is per unit. The second part of the problem says how many units must be sold to break even. Well, that's the fixed cost divided by the contribution margin. So you've got $60,000 as fixed cost, and you're going to divide that by $20 contribution margin per unit. That turns out to be 3,000 units. This is where you really need to pay attention to what you're being asked, because the actual dollar signs cancel out when you have a numerator divided by a denominator in dollars, and when you're subtracting by a fraction, the sign flips and you're left with 3,000 units. So you really need to keep track of these items. And you're asked what would happen if the marketing research shows that 3,100 units can be sold at the current sales price. You end up with 3,100, and that is greater than the 3,000 break-even items that you have. So the decision should be go ahead and sell. But the next part asks about a margin of safety. And the margin of safety is the additional amount above break-even that helps management not go into default, not go into a loss. So if Team Awesome wants a margin of safety of $400, what do? It doesn't matter if you're told how many units they want to have sell as a margin of safety or how many dollars they want to sell. You can solve it either way. In this case, we know they want a $400 margin of safety, and we know that the sales price is $40 per unit. So you end up knowing you need to have 10 extra units sold for a margin of safety. Management's decision is still the same. Marketing says they can sell 3,100 units, and that's greater than the 3,010 units that you have to sell in order to have the margin of safety. The 3,000 break even plus the 10 extra units. So your decision should be to inform management to go ahead and sell again in this item. Now the last part of the problem, there's just one little difference. Instead of having a margin of safety, management wants to have a designated profit and asks you should they still go ahead and sell. Well, a designated profit, we don't call it break even, but we do the same thing. The difference is we're requiring a profit of a certain amount, the same way we have to pay back a fixed cost. So the computation is very similar. You're going to take your $60,000 break even, and you're going to add your $3,000 desired profit. You're going to divide that all by a $20 contribution margin per unit. What happens is you end up knowing that you need to now sell 3,150 units, and you're asked to make your decision on this. Well, if management still figures they could sell 3,100 items, that is now less than the 3,150 items that you need to sell in order to earn a profit of $3,000. So your decision should be not to sell. The second break-even problem does not have as many requirements to the problem, but you still need to do the same kind of things. The first one is how many units are needed to break even. You weren't asked to come up with the contribution margin, but you need to determine the contribution margin in order to solve the problem. So your contribution margin is equal to the $1.75 per slice of pizza minus the 50 cents per pizza cost, variable cost per unit. That leaves you a contribution margin of $1.25 per unit. So how many units are needed to break even? If you have a fixed cost of $1,000 and you're going to go and divide that by a contribution margin of $1.25 per unit, you turn out that you need to sell 800 units or 800 slices of pizza in order to break even. So that takes care of the first part. The second part says prove it. Well, this is where you need to rely on your knowledge of some of the accounting. It's not quite an income statement, but it's a proof. and you're going to prove that you have no income. So you're going to take your revenue minus expenses, just in a slightly different terminology. So if you've got revenue, and your revenue amount is going to be 800 pizzas at a cost of $1.75 a slice, because that's your sales price, you're going to turn around and you're going to have revenue of $1,400. Then you're going to have to subtract out your variable costs. Your variable cost is 800 pizzas at 50 cents a piece, or your variable cost is $400. In accounting, we put parentheses around things to show that we're subtracting them. You're also going to turn around and take less your fixed cost, and your fixed cost turn around at $1,000, which we know. Therefore, you have no profit and no loss, so you're breaking even, and your net income is 0. The third part of the problem, says research estimates they can sell 1,100 pizza slices per game. Should they sell them? Well, the first decision is really easy, because yes, they should sell them. They only need to sell 800 to break even. So that's an easy question. The next part says if the research is correct and you decide they should sell the pizzas, how much profit will they make? Well, let me just erase the problem, some of the basics of the problem, but you're just going to go ahead and figure out the same idea. Instead of having 800 slices at $1.75, now you're going to turn around and you're going to have 1,100 slices. So 1,100 slices of pizza at $1.75 is $1,925. Your variable cost, 1,100 at 50 cents a piece, is $550 as a variable cost. Your fixed cost is still going to be $1,000. Remember, the fixed cost is the cost that does not change based on how many units are produced. So that will give you net income of $375. A quick way to prove that, another way to look at it, is if we only needed 800 pizzas and we turned around and we sold 1,100. So you have 1,100 pizzas minus the 800 minimum. You now have a margin of safety of 300 pizzas. The contribution margin is very helpful here. The contribution margin first goes to pay off the fixed cost, and then it goes to pay off the profit. So if you take the contribution margin of $1.25 and you take 300 slices at $1.25 a slice, you're going to end up with your $375, so that will also show you your profit.